Welcome back. Now we're looking at the risks involved in deals done between venture capital companies and entrepreneurs. In the technology space, these risks are often amplified because often you're dealing with inventions that no one has ever seen before. We're joined now by Ian Harrison. He's Managing Director of Pan-African entrepreneurial technology company Cytec. And still with us in Cape Town is Tony Mallam from Cape Venture Partners. Thank you, Ian, for joining us, and Tony for staying with us through this half. Tony, let's start off with you. Your company providing finance to young South African businesses with very high growth potential. What's the one thing that catches your attention about a company you want to get into? Who would you typically target?
We would typically look at the team. The team is critical. We get approached by many entrepreneurs with some really great technology, whether it's online, whether it's technology itself, hard technology. But the team that brings it to us is probably more important than the technology itself, although we are looking for exciting technology and growth potential.
And going beyond just getting your attention, what process would the entrepreneur have to go through before actually qualifying for finance from your end?
It's a fairly laborious process, unfortunately, but because of the risk that we're taking and investing in these very early stage companies typically, we have to examine the whole concept, the team, the company, the technology itself. We have to look for the uniqueness of the technology, whether it is, are there other players out there that these guys are not aware of? Are they lacking some critical aspects of the technology? What is the IP? So there would be a due diligence process that would look, we have obviously a framework that we work within to look at whether this is an investable innovation. And then from there onwards, it's a case of working together to structure the deal and invest the money and take it forward.
Well, Ian, keeping that in mind then and trusting that all VC companies have a similar mindset, tell us a bit about Cytec, what the company is all about and what your value proposition is.
Well, the thing we're most passionate about is solving problems, and more specifically solving the problems of the emerging markets. Our vision is to be the best in the world at solving the problems of the emerging markets. And we like to be able to do that in a way that is sustainable, that creates a difference to the lives of the people that we sell our products to, that use our products. And we've been going now for just over 18 years, and we believe that we have managed to make a difference in the world, and for us that's important.
In those 18 years, access to finance, I mean, what kind of capital did you need initially, first of all, to start this business?
It was difficult. When we first started out, we didn't have any credibility, and we looked to the banks to see whether they could lend us a small amount of money that we needed, and the banks have very much a belts and braces attitude and very conservative, and that wasn't very successful. So we were fortunate in that my business partner's parents were able to assist us to get us going, and we were able to take the profits that we made from our early business ventures and put that back into the business. And up until probably 8 years into our life, we were relatively self-sufficient and able to sustain the growth that we were looking for through the profits that we were generating for ourselves.
But there came a point then when you did approach a VC for funding.
Yes, we realized that we needed to go the next step with our business, as most companies do when they get to a point. And we were very fortunate through a relationship that we had with one of our customers at the time and members of their board that knew about us because of the business we had with them. And we were able to approach them, the company being Venfin, and they were interested in what we were doing. They looked to only invest into companies that generate their own intellectual property, and those companies which have a global capability, potentially in terms of the technology and products they make. And through a process that took a few months, we managed to come to an agreement, and the relationship that we have with them still today has been a fantastic one for us. We've benefited tremendously from having them with us.
Well, Tony, banks are clearly arguing that it doesn't make business sense for them delving into companies like this that offer such huge risk potential. And that's why, in most instances, traditional trends still hold true when it comes to accessing finance. But you take businesses like Cytec on despite the risk profile they hold. Why? What's the motivation here?
The motivation is always the upside. I mean, we see tremendous potential in some of the businesses that approach us, And because the banks do not have the skills to assess that type of potential and to manage that potential and to manage the businesses going forward, they're not in the business of managing the actual businesses themselves, which is what venture capitalists do. They will not only invest financial money into the business, but they will also provide tremendous networking and business skill injections in there as well. And I think Ian is correct. You know, they've got a great partner in Venfin who have added more than financial investment. They've added their own resources too. And, you know, just bumped the company up a big notch by injecting all of that skill.
Mm-hmm. Did you, Ian, in approaching Venfin, did you think that you were taking on a risk going the venture capital route?
No, we didn't. But I believe that entrepreneurs can take on a risk by doing that, because I think you don't know what you don't know when you're getting into something new. And it's important when you choose a partner, as I think Tony has alluded to earlier, that is able to help you and get your product into the marketplace appropriately. It's not about the technology, it's about what you do with it. And you know, very often entrepreneurs in the early stages don't know that. Yeah. And they need the help. They need the insight that potentially guys like Tony and his group have to be able to take their products and actually make something of it.
Well, certainly both your companies taking on board an element of risk. Tony, how would you go about mitigating some of the risk companies like these pose, though? I mean, investment analysis is critical to take advantage of the opportunities that are held here, but what's the viable strategy to employ financing SMEs like these?
Well, the obvious approach is to take a very close interest in your investments, in the companies you invest in, to beef up the skill sets of those companies, because we're typically approached by technical people, technically minded people, scientists, engineers, innovators, with very little in the way of sales skills, marketing, financial skills. So we boost the team, we add our own resources, we put key people into the team as part of the investment, and in that way we manage the growth through a very, very carefully monitored process and hold the hands along the way. And that's how we mitigate the risk. It's really just to take a keen interest in the going forward process.
And with that kind of involvement, I mean, one would assume that for an entrepreneur who's who views this business as his or her baby, it's got to be very difficult letting go of some of that control. Just what kind of position does that put you in a company?
I think it is a little difficult sometimes, because it is your baby and you've made this thing and it belongs to you. But you have to take a step back, I think, and understand or think about what it is that you want to do with your business. Where do you want to take it to? Mm-hmm. And you can't take something, if you can't take something to the market yourself, and you need to bring a partner in, then you need to give up something for that. Although the thing that you're giving up actually becomes a lot bigger, and you end up with perhaps a smaller portion, but of something that's far more successful than you could have had if you tried to do it just by yourself.
So how important is flexibility then in these relationships?
Because markets change and technology changes. Things move at quite a pace nowadays, particularly in the technology field. So an entrepreneur going into an idea or a new market will have a certain idea or vision about something that may have to change, and the investor may have to move with that. And I think it's important to be able to sit down and say, well, this isn't working the way we envisaged, and we need to change our tactics, or this isn't working at all and we need to do something completely different.
Especially if you want to become a pioneer in the market. So one would assume that's where innovation steps in. And it sounds cliched, but I don't think innovation is really something that can be underestimated here. It's certainly what attracts VCs in most cases, leveraging off a high degree of innovation.
That's true, and it's not just about innovation in technology or in your products. I think you have to be innovative in how you take it to market, and how you fund it, or how you finance it, how you get it delivered into the marketplace. Innovation has a place in all aspects of your business, I think.
Let's look